Good morning, good afternoon. Welcome, agents. Today, I want to talk about not fearing the bubble, specifically bank failures and inflation, and what it means to you and your client. Now, you've seen the news. You've seen Silicon Valley Bank, you've seen First Republic Bank, and now there's even Credit Suisse, which actually was taken over on Sunday in Switzerland by UBS. So this is happening all over the world, and that's because we're all interconnected, right? What happens in one country is going to affect another country. All the other countries have seen inflation just like the United States has. And when one bank starts to collapse, it's a domino effect, and you start seeing other ones collapse. But I want to talk about that specifically for you because, believe it or not, it has nothing to do with you or me or other depositors. It doesn't even have anything to do with those trashy assets that we saw during the 2008 banking crisis. It has everything to do with inflation and spiking of interest rates. Now, if you don't know how the mortgage banking system actually works, let's make that full screen for you. So let's say you go to the bank and you deposit $100,000 into the bank. Now that bank is going to be so generous and they're going to give you half of 1% interest. Now they're going to take the other $90,000, the other 10 or other 90%, and they are going to invest it or loan it out to other people. And when they invest it, they can invest it in things like treasuries that get a fixed return. So they know where they're going to end up. So over the course of the year, if they're paying you half of 1% on that $100,000, you're going to earn $500 in interest. Well, they're making 2% in treasuries from if they bought a couple years ago on that $90,000. So they got paid $1,800 of interest. So the bank is netting $1,300. So that's how they're making their money. Now, think about this. If you multiply it by hundreds of thousands of investors, that is our banking system. So now, due to fighting inflation, the Federal Reserve has been raising short-term interest rates. And some would say that they're raising them without letting it take effect, without letting it work through the system. Because as you raise interest rates, it's going to slow down the economy. And that's going to slow inflation down. So that takes time. It does not happen overnight. And this is why you probably have noticed things like your credit card payments have increased. The loan, if you go to get a car loan, the interest rate's higher. It costs more to borrow from your home equity line of credit. Everything is just more expensive, right? But due to going back to the example of the Fed raising the interest rates, the bank is paying you your half of 1%, right? But you're smart. You're out there over there seeing these other banks and these other accounts that you can go and deposit your money into and earn a higher yield of return. Now, when this starts happening, people are going to the bank and they're pulling their cash out of the bank to go over here and invest it in something else. Now, when this happens, the bank has to raise capital, and they can do that in two ways. They can either take a loan or they can sell assets that they have. Now, stay with me a second. If the bank keeps their assets, which is what Silicon Valley Bank has done, if they keep their assets, which was treasuries, to maturity, they are fine. They don't have to show any unrealized losses on their balance sheet because the treasuries aren't worth today what they were worth when they bought them. They don't have to mark to market certain items, certain assets, treasuries being one of them. But when there is a run on the bank, when people start pulling it out, they need to raise capital. And their balance sheet showed a $15 billion in assets for SVB. But when savvy investors start to see what's going on and they realize that they own a bunch of treasuries, they start telling their clients, hey, pull your money out of SVB Bank because it may not be there. Okay, it could come insolvent. So people start having a run on the bank, pulling their assets out. People start shorting the stock, and you see this snowball effect. Bottom line, SVB had $12 billion in assets on their balance sheet, and they had $15 billion of unrealized losses, which means they were negative or insolvent by $3 billion. You see the problem now? So what does this mean for you and for your clients? Well, there's still issues that need to be worked out. There's no doubt about that. The Federal Reserve has stepped in and stepped up in order to bail out all depositors because they want you and I to keep our money in the banks, and they're saying we will back it. Normally, FDIC only covers $250,000, and that's only if the bank is insured with FDIC. But the government has said, nope, we are going to step in. We are going to pay you your full deposit. So if you have over $250,000, you don't have to worry because the Fed's going to pay you, right? So what does this mean for your clients? So remember last year we had inflation increase, right? And when inflation increased, what do I always tell you? Mortgage rates increase. And the only way to fight that inflation is to raise the federal funds rate, which is what our Fed has done. Now, as they have been raising it, you have seen inflation come down a little bit. Mortgage rates did start to come down, but then you ended up in this SVB crisis, this banking crisis that we're in at the moment, and that is causing some things to fluctuate. Now, the Fed is meeting later this week, and we're going to see what they're going to do. If they're going to raise the federal funds rate, keep it the same. They were originally supposed to raise it 0.25%, so 0.25. However, last week, right before SVB came out with their whole collapse, Jerome Powell, our Fed chair, came on saying he was leaning towards raising it 0.5%, so 0.5. Now, with these collapse of these banks, I think the Fed is either going to do 0.25 point or nothing at all. If you listen to economists like Goldman Sachs, they're saying it's going to be flat. They're not going to do anything. But here's the thing. Think of it like if you go to the doctor's and you're sick and the doctor says, here's a pill, take the pill. 5 minutes, you're not better yet? Oh, well, here's another pill. Here's another dose of that medicine. 5 minutes later, you're still not better? Here's another dose. And before long, the doctor overdoses the patient, right? Because they didn't get better in 5 minutes. That's where our Fed is. The Fed has increased rates, but they have to give it time to play out. And that's what we're not sure if they're doing. They have done their duty. They did what we needed them to do. And now we need them to step back and just wait and let it play out because inflation is going to come down. It just takes time. And one more quick piece. Think about all these bailouts and our government stepping in to handle this. What's going to happen in the long run? The long run means inflation, right? Every time there's some type of bailout, it is the consumers, the American people who end up paying for this through inflation. So right now, it's helping our market, but in the long run, it's going to mean inflation for us. If you have any questions about what's going on in the markets, don't hesitate to reach out to us. That's what we're here for. This video was specifically for you, the real estate agents, so you can explain it to your client. And hopefully I gave you some simpler ways to do that. But don't hesitate to reach out if there's anything that we can help answer for you.